Hello, everyone. Today we are going to have our one of the first in series of sessions about technical analysis. Basically, it will be introduction to technical analysis, and it's just continuation of our previous classes when we talked about trend and the fundamental analysis. Now we are moving to a technical analysis, one of the two key tools used by traders and investors to analyze the market movements and predict the future movements, as this is the key point for traders catching the trend and making profits in their trading. So basically, technical analysis is by definition, although it looks quite complicated, basically it's very simple. It's a study of market action which uses previous movements of the markets, analyzing them, attempting to forecast the future price movements. So, in other words, from one side compared to the fundamentals, technical analysts are focusing on the movements in the market for particular desired instruments that have already happened, and by using tools of technical analysis try to predict the future movements. So this is the a key point of technical analysis, and it's as I said, one of the two key tools that investors use in order to predict market movements, to catch the trends, to see the changes of trends, and basically to make profit, which is the key target for all the traders. A little bit of history of technical analysis. It goes back to 1900s when Charles Dow and his partner Edward Jones created the theories which were basically the cornerstone of the technical analysis, and the technicians nowadays recognize and assimilate the ideas of Dow's theory and use them as a base for technical analysis. As said, Dow theory is the cornerstone of the study of technical analysis, and is based on the three key premises on which a technical approach to market analysis is based. The first one is market action discounts everything. So this is quite common and known, and the markets basically what Dow wanted to say by this is that idea that the market reflects every possible and knowable factor that affects overall supply and demand is the basic premise of technical theory, as the theory applies to market averages as well as it does to individual markets, and even makes allowances for acts of God. While the markets cannot anticipate events such as earthquakes and various other natural events, they quickly discount such occurrences and almost instantaneously assimilate their effects into the price action. So basically, whatever happens, in other words, has been already included in the market movements. So the market action discounts everything. And this is one of the key things that technical analysts use in argument with those who favor fundamental analysis. Of course, good traders and good analysts will always combine these two tools in order to get the best results. The second one, also very important, is the market has three trends. So every market movement is embedded in a trend. And basically what Dow believed is that market is moved by supply and demand, and is always moving in trends. Now, these trends could be divided in certain groups. The first one is so-called the primary trend, and the primary trend lasts for 1 year or more. The second one is so-called the secondary, which is usually opposite reactions, such as pullbacks, corrections, and the moves that go for some time against the primary trend, and the minor, which is seen as a waves. So this could be compared to the things from the nature like tide, waves, and the ripples of the sea. When the primary trend represents the tide, the secondary or so-called the intermediate trend would represent the waves, and they make up the tide, and the minor trends behave like ripples on the waves. So these are the things that are showing the movements of the markets, and basically these are the key points of the technical analysis. So once you understand how the main principles work, then it's much easier to adopt all the tools of technical analysis and get the best results in analyzing markets in order to predict the future movements and get the idea about entry, exit points, stops, which are the crucial for traders in the market. Now we have also certain phases in the trends. The major trends which usually are divided in three important phases, which are an accumulation phase, a public participation phase, and the distribution phase, where the accumulation phase represents informed buying by the most investors. And if the previous trend was down, then at this point, these investors recognize that the market has assimilated and so-called bad news. The public participant phase, where most technical trend followers began to participate when they are basically dragged in the market by signals, occurs when the prices begin to advance rapidly, and this is usually signal for most of traders. When they have a firm signal, then they enter the market and then become to participate. Occurs, as I said, when the price starts rapid advance and sentiment improves. So basically basically are more in favor for such a move, and the market reacts on this. And finally, the distribution phase is the one when the stories start to spread around, increasingly bullish stories start to spread around, and the economic news are better than ever, and the speculative volume and the public participation increase. But during the last phase, the investors who were accumulating their positions near the bear market bottom or top bottom, pardon, bear market will become to distribute their trades. Basically, they will start selling before the majority of people start to liquidate their positions. So this is the third phase. Another thing, the main points of technical analysis come as while fundamental analysis is what we spoke about on previous session. Fundamental analysis focuses on true value by studying news, financial reports, macro and microeconomic events, market outlooks. Technical analysis studies, as we mentioned previously, previous market movements to predict future behavior. So this is the significance of the technical analysis that does not depend on the current events, that such as fundamental analysis that use the releases of various economic indicators, news, geopolitical news, but use the previous market movements in order to analyzing them in order to predict the future movements. The fact that markets move in trends and that which could last for longer or shorter period of time, and they are usually driven by supply and demand. Technical analysis will use to signal when this ratio between the supply and demand starts changing. That will be their initial signal that some changes could be expected in the existing trend, and this is signal that positions that were taken previously and following the trend should be considered. The traders should consider liquidating them, because the technical analysis indicators that are also used in order to get more accurate information. Some indicators give signals in advance, so we can have sort of information before the move starts, basically change of the trend. Technical analysis believe that most of investors, this is about human behavior that applies also on the technical analysis. Most investors have the same or very similar behavior. This is based on the fact that everyone wants to catch the trend, and as most of traders are using the famous words from technical analysis, trend is your friend. So behavior should be the same or similar in observing the market and making decisions for the trades, as what we mentioned in our previous classes. It is quite dangerous and not recommended to go against trends. Some professional traders and experienced traders use corrections to go against the trend, but generally it's highly advised to stay with the trend and greatly reduce risk of losing your funds if you go against the current, against the main direction of the movement. So human factor is that most of traders, majority is having approximately similar or the same behavior, and that factor can apply on technical analysis as human attitude and actions repeat. So basically, as the market moves in waves, the reaction of the traders will be quite similar, talking about those who are following the trends. And the other thing important is that market move in patterns which are formed by price actions, and this is another tool that could provide the traders with the signals. We briefly talked about some candlestick patterns in the previous sessions. We're going to have a class dedicated only to the patterns, where we are going to elaborate more about patterns and the types of patterns and the signals that they produce in order to get more accurate and clearer information about future market movements. As said, the technical analyst will be using these patterns to indicate whether trend is forming, is going to continue, or is going to change direction, which are basically the key points for all traders to have the signal when the trend is going to continue or change direction. In addition to the basic things, technical analysts will be using indicators. Basically, every trading system has charts and a number of technical indicators already embedded inside, so it's easy to be used. They're user friendly, and basically they are mathematical calculations that represent visually the price action. So they are lines, they are clouds, they are moving averages and things, and they are helping traders to get the accurate signals and signals about direction, so they will be able to catch a trend and make profits from their trades. Chart is the main tool of the technical analysts and is the foundation of the whole science called the technical analysis. Basically, chart, you could see charts everywhere. Anything that has certain action could be displayed in a graph or in chart. So technical analysis also use the chart as a key tool. It's a graphical representation of the price movement over a given period of time. So when we want to see how, let's say, gold was moving within past 3 months or past 3 hours, we can easily see it on the chart for gold. And it could be compared to financial statement for fundamental analysis. We were talking about this in the previous sessions. So technical analysis use a chart as the key tool in order to start studying and estimating future price movements in the market. Basically, what are the key points of the chart? As I said, chart shows the price action of financial instrument within chosen time frames, so we can use the different time frames in order to fine-tune our analysis as most traders, different type of traders will be using different time frames which are the most suitable for their type of trading. So we have intraday traders, short-term traders, or longer-term traders. So they will be using different types of charts. A quick look at the chart to see what are the properties of the chart. Basically, we have two axes, x-axis which presents the time, and y-axis which presents the price, and the chart is used to identify trends and changes in those trends. So we can see, for example, on this chart, there is a strong downtrend within a period of past, I would say, 1 month. So the downtrend is defined by the time and by its length. So the price action moved some $25 lower. So we have already information about the key points that we need to know. If there is a trend, how long it lasts, and does it have any signals that this trend could continue. While fundamental analysis may give you direction signal but using technical analysis would provide you with the clearer signal of entry and exit points as well as stops, because what we spoke on the previous sessions with the introduction of fundamental analysis, we can estimate that there will be certain action or moves in the market, depending, of course, on the strength of the releases, whether it was macroeconomic indicator or political or geopolitical news. Technical analysis could fine-tune these predictions and give us more accurate information regarding movements, the length of the current action trend, up or down, and the signals that could provide us with direction of the trend, whether it's going to continue or is going to reverse, and will help us by, of course, using technical analysis tools, so-called indicators and oscillators, to get to calculate our entry and exit points, and to have the optimal situation where we can make the best profits from one trend, one move in either direction. So it could help us to make the right decision. The other things important to mention, types of charts. We have to change the screen for a second. So basically, the initial or the first one that we are going to mention is the so-called line chart. It doesn't give us much information, but direction of the move and the current value over the given period of time. It could be also changed to the various time frames, starting from 1 minute, let's say, or to 1 month. So it gives us more information about movements, but without details. The next one is the bar chart. It's a bit more advanced because bar chart gives us opening price, closing price, high and low of the given time frame. In this case, we're talking about daily chart, so each bar presents 1 day of the trading action. So we have signaled that the market at this point opened higher and closed the lower, so it means that there was a negative move during that day. But the most popular is the so-called Japanese candlestick, which is the most commonly used among the traders. And basically, this what you can see on your screen is the one of the top and most popular setups when the green candles signal bullish action or movements to the upside, meaning that the market opened lower and closed higher. And the length of the body of the candle also signals how was the strength of that move during the given period of time. So, for example, we have that euro US dollar at this day had the strong rally up, and this is a bullish signal. On the other side, we have a red candle, which signals that the market opened at higher and closed at lower level. And again, length of the body signal shows us the strength of that move. While also we have so-called shadows, the lines that are emerging from the body of the candle. And this also present high and low of the given period of time. In this case, we're talking about daily. There are various types of candlesticks. When it's a long green, let's say, or white in the case on monochrome or black and white charting system, that signals that the day was bullish, positive, and as said, the length of the candle body signals how strong was the move, while longer shadows on each direction show that there was a move in certain direction, but the action was not sustained and returned lower or higher depending on the direction. So in this case, we have so-called doji candle. Doji is one of the types of the candles which shows indecision and usually indicates that some change in the direction could be expected. As we can see it here, there was a move up and then doji candle. Doji is the candle with small body and longer shadows. Could be normal, let's call it normal length like this green one, or could be doji with such a longer shadows, which is called long leg doji. And longer shadows represent a stronger indecision in the market. So it could be also seen as an indication that the market he might change direction, which happened. In this case, we had the uptrend that lasted for 4 days, and then we had the doji candle and the reversal down. So candlestick chart is the most commonly used and the most popular among the traders. And also when you add certain economic indicators, then you get a clearer picture about market movements, and we're going to elaborate on this more in our coming sessions, because the technical analysis as a study is quite big, and we are going to break our classes into several lessons, so we'll be going step by step. Today we're just talking about introduction and basics of technical analysis, and further classes will give us more details about most important tools used in technical analysis. And once we complete this, I think we'll be able to use our charting systems and make good decisions in our trading. So we have chosen the chart, candlestick chart, which gives us the most accurate information about market movements in comparison to line and bar chart. And now we'll be looking for the market movements. We are going to define the trends That is the most important thing for traders. And as long as you hold with the trend, you will be on the winning side. So in this case, Euro-US dollar trend has changed and is showing strong signals that it might reverse. Recall to the previous classes when we spoke about trends, we mentioned that break of the trend line is our initial signal that something is developing, and short positions are at increased risk. So traders should consider either closing positions or reversing them, depending on the market signals used by using technical analysis. But in any case, they need to be very cautious when the trend line has broken, and that is initial signal that some things are developing and the trend may change its direction. So we have the trend down, as we said, or trend down, or we have trend up. This is a quite strong trend up, the pair is US dollar, Turkish lira. And here on the sample, we can show the three trends that we mentioned previously. There is a primary and general trend which lasts for 1 year or longer. We have this trend lasting since sometime 2008. So we're talking about 10 years trend. And then the secondary trend, which comes as a correction. This is the one that lasted approximately 4 or 5 months. So it's still, the correction is still underway. And then we have these waves, which also could be called as a noise. When the market moves in a certain direction, but without a clear extension to desired direction. So it's waving. It doesn't go in one straight line, but it's waving. And this is the third type of trends. And now downtrend, as we said, there is a downtrend. We can see the uptrend. So these are the basic things that we need to know when using charts. First thing is to define the trend and follow that trend. If we take a look at the euro-dollar chart that we already mentioned, that there is a strong signal that something is developing. On our coming classes, we are going to talk more about using technical analysis tools that would give us much more accurate information by using volumes, relative strength index, moving averages, Fibonacci retracement levels. All these things together combined give much more accurate and firmer signals what is going on, whether this trend is going to change or it's going to continue after this consolidation. For the time being, we have a breach of the trend line and initial signal. On the other side, we have other sample that shows that initial attempts to change the trend have failed. There were two attacks through the trend line, both ended in strong upside rejections. And now we are going back to the candlesticks where the long upper shadows signaled that there was rejection at the upside. And usually when we have 2 or 3, then increases the strength of that signal. And subsequent action was this is today's action. We're talking about light sweet crude oil. So the market moved sharply lower, which signals that this trend may continue lower. So basic signals, initial signals that something is developing, and the financial instrument is attempting to reverse and enter corrective phase of this steep downtrend have so far faded, and more signal to the downside are applying. Now, if we let's say if we add more indicators to this, then we can see that there are signals supporting our story, with the number of moving averages being in the firm bearish setup. Stochastic is heading south. There is strong negative momentum on both time frames that we use, 14 days and 22 days. So overall picture gives us a signal, and the falling 20 days moving average capped the recovery action. Overall gives us signal that it's more likely that the instrument will continue its downtrend rather than change the trend. In this case, we need to also include the fundamental part, as the market also considers fundamental analysis and news. And in this case, we have the news about crude oil, which are very important. Crude oil is sensitive to all geopolitical movements, to the movements of the major currencies, especially US dollar, as it's represented in US dollars. So we need to consider all these points. But technicals are showing us that things are likely going to continue in already established manner, meaning they are going to continue trading lower, extend its downtrend, as signals are growing now that trend would likely downtrend will likely extend lower. And I think this will be all for today's introduction of technical analysis. We're preparing we're preparing more topics in the coming sessions. So we're going to elaborate all the technical analysis tools used in order to get stronger and more accurate trading signals. So for the time being, we are going to end today's session here.